Welcome to Pride Education. Today our lesson is Income Statement, Introduction. Welcome to Pride Education. In today's lesson we will learn income statement, one of the most important financial statements in accounting. Every student of accounting, business owner, investor and manager should understand how an income statement works because it shows whether a business has earned a profit or suffered a loss during a specific accounting period. The income statement is also known as the profit and loss statement, P&L, or statement of profit or loss. It summarizes all revenues and expenses of a business over a certain period, such as a month, quarter, or year. The difference between total revenues and total expenses represents the net income or net loss of the business. What is an income statement? An income statement is a financial statement that reports the revenues, expenses, gains, and losses of a business during a specific accounting period to determine its net profit or net loss. Unlike the balance sheet, which shows the financial position at a particular date, the income statement measures the financial performance over a period of time. For example, if a company earns $1,000 from sales and spends $800,000 on expenses during the year, its net income will be $200,000. Purpose of an income statement. The main purpose of an income statement is to measure business performance. It helps users to calculate net profit or net loss, measure business efficiency, compare current performance with previous periods, assist management in decision-making, help investors evaluate profitability, help lenders assess repayment ability, provide information for tax calculations. Importance of the income statement. The income statement is important because it provides valuable information about business operations. One, measures profitability. It shows whether the business earned a profit or incurred a loss. 2, helps managers use it to control costs and improve operations. 3, assists investors. Investors analyze profitability before investing. 4, supports credit decisions. Banks and lenders review profitability before granting loans. Tax calculation. Governments use income information to calculate income tax. Components of an income statement. An income statement consists of several important elements. 1, revenue. Revenue is the income earned from normal business activities. Examples: sales revenue, service revenue, consulting revenue. Revenue is the starting point of the income statement. 2, cost of goods sold. Cost of goods sold represents the direct cost of producing or purchasing goods sold. It includes purchase of goods, direct labor, direct materials, freight inward. Formula: cost of goods sold equals opening inventory plus purchases plus direct expenses minus closing inventory. Gross profit. Gross profit represents profit earned after deducting the cost of goods sold from net sales. Text: gross profit, net sales. Text: cost of goods sold. Gross profit measures the efficiency of production and purchasing activities. Now, for operating expenses. Operating expenses are expenses incurred during normal business operations. Examples: salaries, rent, electricity, office expenses, advertising, depreciation. These expenses reduce operating profit. 5, operating income. Operating income represents profit from normal business operations before interest and taxes. It measures the operational efficiency of the business. Now, 6, other income. Income earned from non-operating activities is called other income. Examples: interest income, dividend income, commission income, rent received. 7, other expenses. These are expenses unrelated to normal operations. Examples: interest expense, loss on sale of assets, foreign exchange loss. 8, net profit before tax. It is calculated after adding other income and deducting other expenses. 9, income tax expense. Businesses pay tax on taxable income according to applicable tax laws. 10, net profit after tax. Net profit after tax is the final profit available to the owner or shareholders. This is the most important figure in the income statement. Format of an income statement. A simple format is sales revenue less cost of goods sold, gross profit, less operating expenses, operating profit, add other income, less other expenses, profit before tax, less income tax, net profit. Example of an income statement. Suppose a business has the following information. Sales revenue equals 1,000. Cost of goods sold equals 50 fund. Operating expenses equals 200,000. Interest income equals 20,000. Interest expense equals Rs 10,000. Income tax was 30,000. Calculation. Gross profit equals Rs 350,000. Operating profit equals Rs 150,000. Profit before tax equals 160,000. Net profit equals 130,000. This means the business earned 130,000 after paying all expenses and taxes. Types of income statement. There are two common formats. Single-step income statement. All revenues are added together and all expenses are deducted together to determine net income. This format is simple and suitable for small businesses. Multi-step income statement. This format separates gross profit, operating income, non-operating income, profit before tax, net income. It provides more detailed information and is commonly used by larger businesses. Relationship with other financial statements. The income statement is connected with other financial statements. Net profit increases owner's equity in the statement of owner's equity. Cash received from operations appears in the cash flow statement. Assets and liabilities shown on the balance sheet are influenced by revenues and expenses. Thus, the income statement is a key link in the accounting cycle. Advantages of an income statement: measures profitability, helps management planning, assists investors and creditors, improves decision making, evaluates operational performance, helps in budgeting, supports financial analysis. Limitations of an income statement based on accounting estimates: does not show cash flows directly, ignores market value changes, can be affected by accounting policies, covers only a specific period. Therefore, it should be analysed together with the balance sheet and cash flow statement. Income statement in the accounting cycle. The income statement is prepared after 1. Recording journal entries, 2. Posting to ledger accounts, 3. Preparing the trial balance, 4. Making adjusting entries, 5. Preparing the adjusted trial balance. It is one of the final outputs of the accounting cycle and summarises the revenues and expenses for the period. Conclusion. The income statement is one of the most important financial statements in accounting because it measures the financial performance of a business over a specific period. It shows revenues, expenses, gains, losses, and ultimately the net profit or net loss. Management, investors, creditors, and government agencies rely on the income statement to evaluate profitability and make informed decisions. A strong understanding of the income statement provides a solid foundation for learning advanced financial accounting and financial statement analysis.